14.1 Economic Cost and Profit. In this chapter, we study the firm's goal, accounting cost and profit, opportunity cost, and economic profit. The firm's goal. The firm's goal is to maximize profit. To calculate firm's profit, we must determine its total revenue and total cost. Economists have a special way of defining and measuring cost and profit. They define types of cost into explicit cost and implicit cost. Explicit cost, also known as accounting cost, is out-of-pocket cost. It includes all the costs paid in money. The expenses are tangible in nature. The expenses are recorded in the financial statement of the company. Examples of explicit cost are expenses made by firm on equipment, raw materials, inventory, wages, rent, advertising, electricity, etc. Implicit cost or opportunity cost incurred by a firm when it uses a factor of production for which it does not make a monetary payments. The two categories of implicit cost are economic depreciation and the cost of resource of the firm's owner. There are estimates of the value of alternative activities you have sacrificed or opportunity cost of self-owned resources like labor, time, tools, entrepreneurial talent, etc. Things you could have gotten paid to do. For example, if you decide to go to school full-time instead of working for a salary of $20,000, you're giving up earning $20,000. This is the implicit cost. Economic depreciation. An opportunity cost of a firm using capital that it owns measured as a change in the market value of capital over a given period. The market price the capital at the beginning of the period minus the market price of the price at the end of the period. Suppose a juice shop owner could have sold her blender, refrigerator, and shop on December 31st, 2010 for $250,000. If she can sell the same capital on December 31st, 2011 for $246,000, her economic depreciation during 2011 is $4,000. This is the opportunity cost of using her capital during 2011, not the $10,000 depreciation calculated by same accountant. Interest is another cost of capital. When the firm's owner provides the funds used to buy capital, the opportunity cost of those funds is the interest income foregone by not using them in best alternative way. When the firm's owner supplies labor, the opportunity cost of owner's time spent working for the firm is the wage income foregone by not working in the best alternative job. Finally, a firm's owner often supplied entrepreneurship, the factor of production that organizes the business and bears the risking of running it. The return to entrepreneurship is normal profit. Normal profit is part of the firm's opportunity cost because it is the cost of a foregone alternative, running another firm. Instead of running Sam's Smoothies, Sam could earn $16,000 a year running a flower shop. This amount is an implicit cost of production at Sam's Smoothies. A firm makes a normal profit when total cost equals total revenue and economic profit is equal to 0. So normal profit equals total revenue equals total cost. Implicit plus explicit. Since normal profit is included in economic cost, that is implicit cost, it is a part of total cost of production. It means that the company makes sufficient revenues to cover the overall cost of production and remains competitive in its respective industry. When a company reports a normal profit, it means that economic profit is equal to 0, which is the minimum amount that justifies why the business is still in operation. For example, if a company spends $200,000 every year in expenses, it needs to make $2,000 in revenue to return to a normal profit. Accounting cost and economic cost. Accounting costs are those costs which are recorded in the books of accounts by the accountants or measuring cost for financial reporting purposes like balancing the books, paying taxes, etc. As a result, they define and measure cost by the historical outlay of funds that takes place in the exchange or transformation of a resource. Economic cost. In calculating the cost of a firm, economists include some additional costs that are typically not included in the financial report. It includes opportunity cost, implicit cost in the analysis, and calculates depreciation differently. It is used for decision making, that is, resource allocation, developing strategy, etc. The objective is to determine the present and future cost or resources associated with various alternative courses of action. Thus, we can define accounting cost equals explicit cost, that is paid out of pocket or in terms of money or cash. Economic cost are explicit or accounting cost plus implicit cost. Suppose you are running a small business and incur the following expenses. Labor equals $80,000, raw materials $30,000, finance charge on a loan $30,000. You're not paying explicit rent because you own the building you're operating in. If you would rent it out, however, you could be earning $12,000. You also estimate your own time to be worth $25,000. What are your expenses? Now, first let's calculate the explicit cost, which is $80,000. Explicit cost which are paid in money or cash. So here we find the expenses are labor expenses, pays labor wages, that is $80,000, raw materials $30,000, finance charges on a loan $3,000, which totals $113,000. Now, what are implicit costs, which are foregone expenses, or we now here the earning foregone from the rent, or the rent foregone by the owner of the building is $12,000, and the time foregone which worth $25,000. So these two are implicit cost, which equals $37,000. The total economic cost is explicit plus implicit cost, which totals to $150,000. Now let's calculate economic profit and accounting profit. The economic profit equals total revenue minus economic cost, which includes both implicit and explicit cost. Accounting cost equals total revenue minus explicit cost. Let's solve a problem. Let's say that a firm's total revenue is $80,000 and the explicit cost and implicit cost are $70,000 and $25,000 respectively. What are the firm's economic and accounting profits? Solution: the economic profits are $80,000 minus $95,000, which is negative $15,000, a loss of $15,000. Accounting profits are $80,000 minus $70,000. It is $70,000 is just the explicit cost, which equals $10,000. So here we can see from accounting profits it is showing a profit of $10,000, whereas from economic profit there is a loss of $15,000. So from the financial point of view, assuming no changes in cost and revenue, should the firm in the example continue to operate? The firm reaps a positive accounting profit of $10,000. Thus, the firm has a positive cash flow. However, the negative economic profit indicates that if the owner had put his time and capital in the alternative activity, should have earned $15,000 more. Therefore, from a financial point of view, assuming no change in the future costs and revenue, it is better for the owner to discontinue the business and pursue the alternative activity. So this is an example of two views of profit and loss. That is, both economists and accountants measure a firm's total revenue the same way. The total revenue is the price times quantity sold. In the first block you can see, and the total revenue in the table you can see is $150,000. Opportunity cost of resources is $100,000, which includes both implicit cost and explicit cost. You can see in the table above, which shows the economic accounting, the total revenue is $150, and explicit cost of a juice shop is shown here, which and the implicit cost. This is owned by Samantha, and it shows all the expenses she has foregone, and it also includes the economic depreciation and normal profit, implicit cost. You can see in the table, and it totals both implicit and explicit cost is the opportunity cost of the resources, which equals $100,000. So the economic profit is the total revenue minus total cost, which equals $50,000. And the accounting profit from the economic points we have already seen. Total revenue minus opportunity cost, which includes implicit cost including normal profit and economic depreciation plus explicit cost. The accounting view, you can see from the blog, total revenue equals only explicit cost, which is nothing but the cost paid in money plus depreciation. So these are the two views of calculating cost of a company, cost and profits of a firm or a company.